Last year, FCT DPU was up by a miserly 0.6%. Will this year see a bigger jump? Let's explore. A year ago, after attending the AGM, I felt quite optimistic about an increase in the distribution per unit for last year. This optimism was largely driven by the expected full-year contribution from Tampines 1 and stable borrowing costs. Indeed, we saw healthy growth in both revenue and net property income, both up around 10% over the previous year. But boy, was I surprised when DPU was up only by 0.6%. Luckily, I wasn't overwhelmed by my emotion, and my analytical mind took over. One key reason for this was the North Point City South Wing acquisition, which only contributed for a few months in the last fiscal year. Additionally, there was full dilution from the new units issued during the equity fundraising exercise impacting the DPU. And if you have participated in the EFR, you would have made a good profit, which made up for the slower DPU growth. Beyond the EFR, rental arrears from Cathay Cineplexes worsened the situation. Here's the estimation by Gemini on how FY2025 DPU was impacted by the various events. Now let's shift our focus and consider what we can expect for the upcoming fiscal year 2026. I just attended the AGM last Friday. It's FCT's 20th anniversary. I'm grateful for the goodie bag sponsored by the management. Together with the 1Q 2026 Business Update issued on the same evening, I see 4 positive factors that could lead to a higher DPU in the coming year. Firstly, you'll benefit from a full-year contribution from North Point City South Wing. That's additional 8 months of income without further dilution. Secondly, Hougang Mall's B1 and L1 levels are opened with refreshed spaces. Being key footfall areas and expected ROI of 7%, this will bring in some income. Thirdly, the cinema spaces at Causeway Point and Century Square have been successfully backfilled in January. This means FCT malls are fully occupied again. Fourthly, we're seeing a trend towards potentially lower finance costs, with the average cost of debt already showing a decrease. But what about RTS Link? Many are concerned about its impact on FCT properties when it starts to operate next January. Before proceeding to talk about the elephant in the room, I would appreciate it if you could take a few seconds to like this video and subscribe to the channel. Thank you. Since RTS will only complete this December, it will have absolutely no impact on FCT FY 2026 performance. However, looking further ahead to 2027 and beyond, the RTS Link could certainly bring some interesting dynamics. Some are worried that it would parallel what happened at Hong Kong and Shenzhen, with Hong Kongers crossing the border for cheaper options. But it's crucial to remember that Johor Bahru is not Shenzhen. It's a much smaller market and connectivity beyond the city isn't as convenient. While food and services might be cheaper, international brands are often priced similarly. FCT CEO Richard shared anecdotally during the AGM, shoes from a Singapore brand actually cost cheaper in Singapore than JB. More importantly, the northern region of Singapore is set for significant rejuvenation with new homes and improved connectivity planned. In short, the pie is growing. Let's visualize a simple model of this growing pie. Imagine owning the only bubble tea shop in a small town, selling 1,000 cups daily. It's a steady business. Now, a new road opens, allowing residents to buy cheaper tea elsewhere, causing your sales to drop by 10%. But simultaneously, the town expands, potentially increasing your customer base to 100 to 200 cups if there was no leakage. The math is clear. A bigger town with a small leak is better than a small town with no leak. Growth can outpace the leakage. The study by CBRE, which you can access in FCT annual report, suggests that the impact is minimal. Leakage will only increase from the current 3 to 4% to approximately 5% by 2032. However, these developments aren't concurrent. The RTS operates from 2027 and new housing will only be ready progressively from 2029. So expecting an impact on the footfall in 2027 is intuitive. My family is definitely giving RTS a try, but unlikely to do it regularly, but others might visit more often. Therefore, leakage might be higher in 2027 or even 2028. That said, I'm not losing sleep over DPU. For one, not all leases will expire during this period. Also, FCT is planning to transform Causeway Point into a regional mall. So will DPU grow meaningfully this year? I think the chance is good, given the various drivers. However, growth might be less than anticipated, depending on how much cash is retained for asset enhancement initiatives at Next and Causeway Point. Even if the DPU remained unchanged, the forward yield at the current share price is still a very attractive 5.4%. So is FCT for you? Comment to let me know. For me, FCT doesn't give me the most alluring returns, but it offers a sustainable, high-quality yield that fits its defensive role in my portfolio perfectly. If you would like to have more details from the AGM, visit my blog to read my latest post. Thank you for tuning in. See you in the next video.